All information in this video is intended as educational information only and is not intended as financial advice. I'm Josh Olswich, head of research at Valkyrie, and let's go over a midweek market update. Prices in the cryptoverse have been quite volatile, especially on lower time frames over the past few weeks. We certainly had a large unwinding of Chinese trader positions thanks to the PBOC and Chinese regulators halting trading in China. And we can see evidence for that based on open interest of those exchanges relative to Binance specifically, which has grown significantly. And here in the USA, now we have adjusting Fed policy, perhaps coming to the realization that the free money risk on era may be coming to a close, depending on who you ask on any given day. But for me, as a trader, as somebody who likes to focus on technicals, let's just start with the correlations of the S&P and Bitcoin since December 4th. This is a low time frame chart, but even without running the numbers for correlations, you can quickly see that the Bitcoin price and the S&P price is extremely correlated, has been extremely correlated recently. Markets did not find the news of rate hikes this year a few days ago bullish. And once the FOMC minutes were published and released, there was certainly an immediate reaction as that fear gets priced in. And we have the likes of Jamie Dimon saying he thinks there's going to be more than 4 rate hikes this year. Powell saying, we're not sure what we're going to do. We're going to meet again in January to tell. And then today we have CPI numbers coming out showing massive increases with inflation potentially reaching 7 to 10%, depending on who you ask. And all these things are, of course, relevant and matter. But all I can see as a trader is the correlations here between the two markets, between legacy markets and crypto markets. So in order for Bitcoin to become Bitcoin again, we need to first decouple from price reactions, which are related to Fed announcements, Fed policy, Fed decision-making. That may not happen this quarter, that may not happen this year, but it's certainly something to continue to watch for the next several months until we decouple, because there's really no point in saying, I'm bullish, I'm bearish, things look great, things look terrible. It doesn't matter if it's all connected to the same market, the same correlations, and we're having to guess on which day the Fed is going to come out deciding on tapering, deciding on rate hikes, and finally coming to grips with inflation. And if we look at inflation, again, CPI 40-year high. This is from Lynn Alden on Twitter sharing this data, but we are in unprecedented times, certainly in that regard. And back to the correlations for a second, not only are BTC and ETH correlated extremely highly, this is 60-day rolling since 2018, 80% correlation there, depending on how you want to massage this. This is the 1-year rolling, also essentially sitting at 80%. A lot of people ask about BTC and ETH individually, but ultimately, again, if these are correlated, they will not act on their own. And if BTC is correlated to the S&P, this is the 360-day rolling correlation ever since the COVID activity in March 2020, this correlation has continued to increase, continued to rise. And again, depending on how you want to massage this, we can look at these correlations even most recently, entering an unprecedented era of high connectivity after 2020. Impossible to ignore. Perhaps it's because the same people who bid up legacy markets are bidding up crypto markets now. As the market cap grows, we need more and more money to sustain it in a nominal way. As crypto grows, it is on more radars of the financial hive mind. Also one possibility. And another correlation I love to watch is the correlation with the volatility index, or the VIX, of the SPX, also known as the fear index. Typically when the VIX rises, we're seeing terrible days in legacy, as in bearish days for legacy. And this again is the 360-day rolling correlation of the VIX to BTC USD prices. And there is a strong inverse relationship here, much like the SPX, so no surprise, but there's a strong inverse relationship here between the VIX and BTC. So fear in legacy markets is felt just as significantly in BTC markets, certainly. And this correlation, again, depending on how you want to massage this data, is trending towards unprecedented connectivity between all these markets. So it's certainly something to watch. And it's perhaps why when we see outflows like we do, this is from CoinShares, dating back to mid-2020, when we see these outflows, one reason to not get bullish or to keep things in mind here, yes, we're still in a 1-year range, but ultimately we need new money, we need dry powder, we need a certain equilibrium to keep price where it is at the very minimum, let alone return to the prior bullish period. This massive inflow here was when the first couple ETFs came online, and it certainly held quite high for many weeks thereafter. But over the past few weeks into 2022, perhaps as risk-off acknowledgements come to reality and fruition, we're seeing lots of outflows there. So switching gears to technicals specifically, if we want to zoom way out and be as conservative as possible, hoping for the best, planning for the worst, as they say, is there any indicator, historically, this is something you can ask yourself, that has helped figure out where the bottom was before it got there? One such indicator is the 200-week moving average. On here's the exponential moving average and I guess the SMA, EMA versus SMA. EMA tends to favor near-term data over a general rolling period of 200 weeks. But using both of these together, we see, okay, we get some bearish targets here. You can also say historically, we have not held below the 200-week MA for a sustained period of time ever. Not only did it triple tap in 2015, but it also caught 2018's double tap and also caught March 2020. So past results aren't indicative of future performance, but it's certainly something most people are going to be watching here should things get turbo bearish over the next couple months. So for me as a trader, seeing this range between 25 and 19, yes, it's large, as is the range we're currently in from 30 to 60, but it does give you some idea of things to look for when we're in that level. Perhaps we see a type of chart pattern, either what's known as an Adam and Eve in this case, a V and a U. Maybe we see an ascending triangle. Maybe we see an inverted head and shoulders. Maybe we see a type of Wyckoffean accumulation that we saw in 2015. There's all sorts of things we could see. Maybe we see a V bottom like we did in March 2020. That decision tree is yet to fill its branches and leaves, but we can see where that tree is planted. We can see that these are the levels that are going to be highly important based on historic precedents should we approach them. So that's zoomed way out. That's most conservative, right? Something else to look for in the now is how do these MAs or EMAs look on lower time frames? Generally, if you get a higher time frame moving average crossing over a lower time frame moving average, you see bearish activity. A perfect example of that is 2018. If I'm going to cherry pick one thing, it's 2018 to 2019 and then 2019 to 2020. You see these crosses in action. Are they always perfect? No. Can they be noisy? 100% yes. Will they always give you an exact trade setup? No. For me, the most important crosses to pay attention to are crosses that have not happened in an extended period of time. So this May 2020 to May 2021 cross is telling you there is a massive shift in trend as happened previously. Going forward throughout 2021 and 2022, as we get more frequent crosses as we did in 2019 and 2020, they become less valuable, more noisy, but they still give you some idea of expectations, at least in the near term. And we are cross bearish and have been cross bearish now for a couple days on EMAs. This is known as a death cross versus a golden cross, the bullish version. So we're death crossed on the daily. We don't lean bullish right now. We're below the 200-day moving average, another litmus test for trend. So that's certainly problematic for expectations of upside in the near term. Another type of MA we can look at and watch is the 2-year moving average and the multiplier component. Again, this is looking at backtesting specifically on high time frames, much like high EMAs in any analysis. But the first question is, can we use something that works historically? Here for me, the answer is yes. And then can we apply that going forward as far as looking to levels should we get there, right? Much like that 200 EMA and MA example, the 2-year MA below that has been a buy zone. Above that multiplier, in this case it's the 5x multiplier, has been a sell zone. Arguably, we've hit these zones on every single buy and every single sell since 2013. So it's certainly something that I'll be watching going into 2022 as far as a support level at 29.5 currently and a sell level at 150K or 150,000 currently. These will adjust obviously over time, up or down. it doesn't give you an exact pinpoint, right? TA tells you when to buy, timing the market. People generally are against that sort of thing. FA, fundamental analysis, tells you what to buy. But if we're talking about something like dollar cost averaging, again, not investment advice, but this is the period for me when dollar cost averaging into Bitcoin certainly becomes more appropriate than otherwise. Now, it doesn't tell you, again, when that's going to end. It doesn't tell you the end of the bear market. It just tells you the beginning. Something else I'm watching in the immediate near term is the potential possibility of this mangled head and shoulders that we have before us based on price action. TA is a bit voodoo, a bit chicken bone reading. But again, this stuff has historic precedence in all markets, no matter what it is, dating back to the beginning of time since trading began and prices were recorded on a regular basis. So this is a bearish reversal pattern. And you typically see this at the top of a range. We saw this potential version from 2021 up until July, August 2021. And the general shape you want to look for in this type of chart pattern would be a series of 3 highs with the 2 lower highs matching each other on a horizontal level. Again, both of these are imperfect examples, not textbooks certainly, but they cannot be ignored as a potential reality. And just as the invalidation criteria here, or for any head and shoulders, is a break above the right shoulder, so left shoulder, head, right shoulder, same too is the criteria for nullification currently at 51.6. So for me, yes, we have this $30,000 range since 2021, but we have this very tight, arguably, range from 40 to 50. No coincidence that those are psychological levels as well. But we have this tighter range here, this hyper volatile, historically messy, random walk, turtle soup, maybe as you'd refer to it, hyper volatile period, where we will know soon enough, based on lower lows below 41, based on higher highs above 51.6 in this case exactly. And there's some other things here that can tip us off as far as strength or weakness. These horizontal bars represent volume at price and can also be seen as support and resist levels. Currently, there's a very large node of volume or volume node at 47,000. There's a lot of support from 31 to 39 thanks to all the activity in that area in 2021. So as we start potentially rolling through some of this resistance to the upside, then I personally can get more and more bullish at the prospect of revisiting all-time highs. But currently, as we sit here, we are still below 47K, still below. Also, the yearly pivot, which is this thin yellow line here, which tells you support resistance levels based on the prior year's trading history. So we're below the 200-day moving average. We're below a key yearly pivot. We're below volume currently. We're hanging on by a thread on this neckline, as it's referred, this horizontal level at 41K. So yes, have we had a decent bounce since then? Sure. But to get bullish here, I think, is a bit foolish until ultimately we regain 50 to 51 for a significant period of time. Something else in regards to this chart pattern is all chart patterns have a bias and they have an expectation for price targets, which is one of the reasons why chart patterns are so valuable. So like I said, this has a bearish bias, carries bearish sentiment, as well as measures a price of very near those early targets of the 200-week EMA or lower, depending on how you want to measure this and what you want to use. I like fib extensions in this case, but the 1618 fib extension measures to not only below the S1 yearly pivot, but below the August low, below all this VPVR support. So if you're bullish, you certainly don't want to see this play out because it would represent a trajectory to multi-month lows, almost certainly, even despite this large volume support from 30 to 40. Real quickly on ETH, the same TA could be applied and should be applied in the same manner if you're being honest with yourself. Just starting with the 50 and the 200, ETH is still in a bullish 5200 cross and has been for the past 620 days plus. This is the longest period of a bullish cross for ETH since trading began in 2015. Not even the 2017 trend lasted this long. So to see weakness in trend here with a potential death cross coming up is certainly reasonable on an asset that is up 1800% since the bull cross in March 2020 or thereabouts, May 2020. So I think that's important to keep in mind if you're still extremely bullish up here. I think we all need to realize the percentages that things are up since 2020, legacy markets included. Nothing is excluded here since this V bottom we made on all markets in 2020. So ETH is also below its 200-day moving average. Historically, again, as a litmus test, this is not a bullish indication. And in general, ETH, since inception, has held above its 200-day moving average most of the time, which is pretty remarkable in its own right. But the 600-day bullish cross coming to a close here. Looking at ETH's 1-year MA, because I don't have enough data on ETH for a 2-year MA, but looking at ETH's 1-year MA, again on backtesting, does show a support area of 2,800. Support as in supporting evidence for the bear market, I guess you could say. Again, this doesn't tell you how long we're going to be below that level. It doesn't tell you if it's going to go in and out. It just says historically, based on the prior year 365 rolling, 2,800 or lower is a decent area to potentially start getting back into ETH again. 14K plus at this point being the top side. But this has been extremely accurate even since 2016, 2017, catching that micro bottom. And certainly tells you now as in below 2,800 is a better time to be buying than near the 5x multiplier. And then lastly, again for ETH on the USD pair, just as BTC has a chart pattern known as a head and shoulders, a reversal pattern, ETH for the entirety of 2021 really had an imperfect version of what's known as a cup and handle. And how this typically plays out is you see some sort of U or slow recovery from a high after an extended drawdown, a retest of the high that's unable to continue. And then the second retest of that high is where price tends to make its move in a bigger way, in this case, towards price discovery, towards new all-time highs. So I'm not saying I'm more bullish on ETH, but I am saying ETH does look better here compared to BTC. So the correlations still matter. Everything still matters, but ETH is still above the 50% level of the mega range from May to July. Another important criteria for a cup and handle is that this level is held and maintained. And you could argue maybe it invalidated it here. That's fine. Again, this is very imperfect, and this isn't always going to be very textbook. But one thing I think a lot of people are still watching is the potential that this plays out. So if this 50% level can hold, if we can revisit 4,400 plus in the coming weeks, potentially related to any ETH 2.0 stuff, then I think it's fair to get bullish again. Until then, just as with BTC, we are in this range of chop between 44 and 30 or 3K. There's also some lower time frame falling wedge and or falling channel stuff going on here. But ultimately, I don't think it's fair to be bullish in the near term on BTC or ETH based on MAs, based on a lot of things. If BTC starts to break down to range lows, ETH will not be spared. ETH will break down below 3K almost certainly and retest 1,800 should BTC retest 30,000. So that's all I have for this one. Like, dislike, comment, share, subscribe. Happy trading.